And that's when I saw the filing, 528 million ounces. Let me say that again, 528 million ounces of physical silver sitting in BlackRock's iShares Silver Trust as of January 2nd, 2026. That's not a position, that's an army. While everyone was watching JP Morgan, the villain we've been told to fear for 15 years, BlackRock quietly assembled the second largest stockpile of physical silver on planet Earth. $40 billion. Not in paper contracts, not in derivatives. In actual, physical, audited silver bars sitting in HSBC and JP Morgan vaults in London. But here's what makes this different from everything you've been told. BlackRock doesn't own this silver. The investors in SLV, the exchange-traded fund, technically own it. Which means BlackRock has done something far more sophisticated than JP Morgan ever attempted. They've created a mechanism to control 60% of annual global silver production without taking ownership risk, without price exposure, and without anyone noticing until it was too late. December 26th, 2024. While you were celebrating Christmas, something happened that changed everything. SLV saw inflows of over $1 billion in a single week. Not gradual accumulation, panic buying, and when that money floods into SLV, BlackRock, by the rules of the ETF structure, must go into the physical market and buy actual silver to back those shares. The mainstream narrative is that this is just passive investment flow, random investors buying a silver ETF. But let me show you what they're not telling you. 4 major South Korean banks stopped selling physical silver to retail customers on February 14th, 2025. The same month, SLV saw record inflows. Shanghai premiums hit 12% over London spot. Backwardation appeared in the futures market for the first time since 1980. This isn't about BlackRock making a bet. This is about BlackRock positioning themselves at the front of the line before the greatest shortage in commodities history. And I'm going to show you exactly why they know what's coming. To understand what BlackRock is really doing, you need to understand the difference between owning silver and controlling it. Because what they've built is not a position, it's a monopoly on the exit door. Let me give you the framework. There are 4 ways to have exposure to silver in the modern financial system, and each one represents a different level of counterparty risk. Stage 1 is paper claims, futures contracts, unallocated accounts, mining stocks, certificates. This is what 99% of silver investors actually own. A promise from a bank or exchange that they'll deliver silver if you ask for it. The problem? The leverage ratio in the paper silver market is estimated at 250 to 1. That means for every ounce of physical silver that exists, there are 250 paper claims against it. It's a game of musical chairs where only 1 out of every 250 people gets a seat. Stage 2 is allocated physical and bank storage. You buy physical silver, but the bank stores it for you in allocated form, meaning specific bars are assigned to your account with serial numbers. Sounds safe, right? Except you're trusting the bank to actually segregate your metal and not lend it out or hypothecate it. Ask the people who had gold at MF Global in 2011 how that worked out. Allocated turned into unsecured creditor real fast. Stage 3 is personal possession. You physically hold silver coins or bars in your own vault or safe. True ownership, zero counterparty risk. But here's the ceiling. Retail investors can only move small amounts. Try buying 500,000 ounces as an individual. You'll pay massive premiums, deal with logistics nightmares, storage costs, insurance, security, and you'll move the market against yourself with every purchase. Stage 4 is the BlackRock model. Create an ETF that legally must hold physical silver, audited by third parties, with inventory reports published daily. Attract billions in institutional and retail capital. Use that capital to go into the wholesale market, where premiums are lowest and liquidity is highest, and vacuum up physical metal at scale without moving the price until it's too late for anyone else to react. Here's why Stage 4 is genius from a strategic standpoint. BlackRock collects a management fee of 0.50% annually. On $40 billion in assets, that's $200 million per year in revenue. They take zero price risk. If silver goes to $100, they make money on fees. If it drops to $20, they still make money on fees. They have no incentive to manipulate the price up or down. Their only incentive is to maximize assets under management. But here's what makes this the most important position in the entire silver market. When the paper market breaks, and I'm going to show you the evidence that it's already breaking, SLV becomes the only institutional-grade exit door. Pension funds, sovereign wealth funds, family offices cannot take delivery from COMEX. They can't store 10 million ounces in a private vault, but they can buy SLV shares in seconds and get exposure to physical silver without any of the logistical headaches. You know what else happened with this exact structure? In 2020, during the Reddit silver squeeze, SLV inflows forced BlackRock to buy 170 million ounces of physical silver in just 6 months. That single buying wave pushed premiums to 40% over spot and caused delivery delays at every major mint on Earth. The US Mint, the Royal Canadian Mint, Perth Mint, all of them ran out of inventory. People were waiting 4 to 6 months for delivery on basic silver eagles, and that was with just 170 million ounces of demand. BlackRock now holds 528 million ounces, more than 3 times that amount. When the next institutional panic wave hits, there won't be enough available silver at any price to satisfy the demand without completely breaking the pricing mechanism. Here's the historical pattern we're watching repeat in real time, and it's happened 3 times before with the exact same outcome. In 1980, the Hunt brothers from Texas accumulated roughly 100 million ounces of silver through futures contracts and physical delivery. Silver ran from $11 to $49 in a matter of months as they squeezed the shorts. The CBOT and COMEX, in direct coordination with the Federal Reserve, changed the rules mid-game. They implemented position limits, banned new long positions, and forced liquidation-only trading. The Hunt brothers were cornered and had to sell into a collapsing market. Silver crashed from $49 to $11 in 8 weeks. Fortunes were destroyed overnight. The lesson Wall Street learned from 1980 wasn't that cornering silver is impossible. The lesson was that you can't be an outsider trying to squeeze the system. You have to be the system. You have to control the infrastructure itself. Fast forward to 2008. Bear Stearns collapsed in March holding a massive concentrated short position in silver futures. JP Morgan stepped in as the white knight, absorbed Bear's entire derivatives book, and took over the short position. For the next 12 years, JP Morgan was fined repeatedly by regulators for spoofing, manipulation, and rigging the precious metals markets. In 2020, they paid $920 million to settle criminal charges, the largest precious metals manipulation penalty in U.S. history. But here's what they were doing with the left hand while everyone watched the right hand. While JP Morgan was suppressing the paper price with massive short positions and paying fines for manipulation, they were simultaneously accumulating physical silver in private vaults. Industry estimates now put JP Morgan's physical silver holdings at somewhere between 750 million and 1 billion ounces. They spent a decade suppressing the paper price while stacking physical at artificially low prices. Now, look at the board. JP Morgan holds up to 1 billion ounces in private vaults. BlackRock holds 528 million in the SLV ETF. Between just 2 entities, that's potentially 1.5 billion ounces. Global annual mine production is 880 million ounces. Do the math. These 2 players control more silver than the entire world mines in nearly 2 years. But here's the critical difference that changes everything about how this plays out. JP Morgan's position is hidden. It's not audited, it's not reported to regulators, and it carries enormous legal and reputational risk. If they get caught manipulating the market again, the fines could run into the billions. They could face criminal prosecution. They're holding the smoking gun with their fingerprints all over it. BlackRock's position is completely transparent. The SLV ETF is audited by independent third parties. Inventory is published on their website every single day. And it's 100% legal. They're not manipulating anything. They're simply providing an investment product that the market is demanding. When the shortage becomes undeniable and prices explode, BlackRock can point to the ETF structure and say, "We're just the custodian. We're holding what our investors bought." Zero liability, zero legal exposure, zero reputational risk. This is the most sophisticated front-running operation in the history of commodity markets, and it's hiding in plain sight on a publicly traded ETF. Now, let me show you what's actually happening in the physical silver market right now. Because while the paper price bounces between $60 and $65, the real market, the one where actual metal changes hands, is screaming a completely different story. COMEX registered silver inventory. That's the metal that's actually available for immediate physical delivery to futures contract holders. As of January 2026, registered inventory sits at 47.2 million ounces. In 2020, that number was 84.9 million ounces. In less than 5 years, deliverable inventory has dropped by 44%. Nearly half of the silver that was available for delivery has vanished from the exchange. Now, defenders of the system will say there's still around 280 million ounces of total COMEX inventory when you include eligible silver. Here's the problem with that argument. Eligible inventory is silver sitting in COMEX-approved warehouses that could theoretically be registered for delivery, but currently isn't warranted for sale. The owners of that silver have not made it available to the market. It's their private property sitting in a COMEX vault. It's like me counting all the cars parked on your street as part of my personal transportation fleet. Technically, they're nearby. Technically, they're vehicles, but they're not mine to use. And watch what happens during delivery months when people actually stand for physical delivery. In March 2024, there were 4,200 silver contracts that stood for delivery on COMEX. That represents 21 million ounces of silver that buyers demanded in physical form. The exchange claimed successful delivery by shuffling warehouse receipts. The same 1,000-ounce bars get moved from eligible to registered status and back again. Receipts change hands, and COMEX declares another successful delivery month. It's a shell game, and at some point there won't be enough shells to keep the game going. Let's talk about premiums, because this is where the lie becomes mathematically obvious. In a normal, healthy commodity market, the premium for physical delivery over the paper spot price is typically 1% to 3%. That covers refining, fabrication, transportation, and dealer markup. When premiums spike above 5%, it signals supply stress. Above 10%, it signals an outright crisis. Current premiums as of January 2026. American Silver Eagles are selling for $8 to $10 over spot. That's 12% to 15% premium. 100-ounce silver bars from major retail dealers are running $5 to $7 over spot. Even 1,000-ounce commercial bars, the kind that institutions and large investors buy, are commanding $3 to $4 premiums over spot. Even at the wholesale level, where premiums should be nearly zero because you're buying in bulk directly from refiners, buyers are paying 4% to 5% above the quoted COMEX price. What does that tell you? The paper price is fiction. The real price of silver, the price at which you can actually acquire physical metal and take delivery, is $68 to $75 per ounce right now. Not the $65 you see on financial websites. Backwardation. Let me explain why this matters, because when backwardation appears in silver, it's a 5-alarm fire that signals the pricing mechanism is breaking. In a normal commodity market, future delivery prices are higher than spot prices. That's called contango. It makes perfect sense. If I'm agreeing to sell you silver for delivery in 6 months, I need to be compensated for storage costs, insurance, financing, and the opportunity cost of not selling that silver today at the current price. Backwardation is when that relationship inverts. When the price for immediate delivery is higher than the price for delivery 6 months from now, it means people are willing to pay a premium for silver today, rather than accept a promise of silver tomorrow. That only happens when there's either panic about counterparty risk or severe physical shortages where people don't trust they'll actually get the metal if they wait. In late 2024 and continuing into early 2025, silver futures showed backwardation for the first time since 1980. The last time this happened, Silver went from $11 to $49 in less than 12 months before the Hunt brothers' corner was broken by exchange rule changes. Now let's look at what's happening in international markets because this is where you see the real fracture lines in the global silver system. The Shanghai Gold Exchange trades physical silver with mandatory immediate settlement. No paper games, no fractional reserve. You buy silver on the SGE, you get actual silver delivered to your account within 2 business days. Period. In a functioning global market with arbitrage, prices in Shanghai should track London and New York within a few percentage points. If Shanghai silver was trading at a significant premium, arbitrage traders would immediately buy in London, ship to China, and sell in Shanghai to capture the spread. That arbitrage pressure should keep prices aligned, but in late 2024, Shanghai silver premiums over London spot hit 12%. 12%. And that premium persisted for months. That means it was more profitable to buy silver in London, pay international shipping, pay Chinese import duties, pay all the logistics and handling costs, and sell it in Shanghai than to do almost anything else with that capital. And yet, the premium remained. Why? Because there wasn't enough silver available in London to arbitrage. The physical market was already that tight. The metal wasn't there to buy and ship, even at a 12% profit margin. February 14th, 2025. Valentine's Day. While you were buying flowers, 4 major South Korean banks announced they would no longer sell physical silver to retail customers. Not reduced limits. Not higher premiums to ration demand. Complete halt. Indefinitely. The banks gave no explanation. They didn't need to. When a bank stops selling an asset, it's because they either can't source it in the wholesale market or they need to preserve it for their own balance sheet requirements. This wasn't one small regional bank making a policy change. This was 4 major national banks in the world's 10th largest economy simultaneously shutting off retail access to physical silver. And the mainstream financial media didn't say a word about it. Then in late 2024, something happened that should have triggered alarm bells across the entire financial system, but somehow got buried in the news cycle. 2 major European banks pulled $17.2 billion from the Federal Reserve's emergency repo facility in a single day. The repo facility is the financial system's emergency room. It's where banks go when they desperately need overnight liquidity and can't get it anywhere else in the private market. $17.2 billion in emergency liquidity accessed by 2 banks on the day after Christmas. You don't tap the Fed's emergency window because business is good. You tap it because you're hours away from a balance sheet crisis. And what were these banks short? What exposure were they desperately trying to cover? The reports didn't say, but the timing coincided exactly with the massive inflows into SLV and the Shanghai premium spike. Here's what I think is happening, and I want you to follow the logic chain. Major banks in Europe and Asia have been running fractional reserve schemes in silver for years. They sell unallocated silver accounts to clients, collecting fees and using the float. In theory, they hold some physical backing. In practice, the leverage ratios are somewhere between 50-1 and 100-1. It works perfectly as long as redemption requests stay low and predictable. But starting in late 2024, something changed. Redemption requests started spiking. Clients started demanding physical delivery instead of rolling over their paper accounts. Maybe it was fear of bank failures. Maybe it was inflation concerns. Maybe it was rumors spreading about shortages. Whatever triggered it, the banks suddenly needed to source physical silver to meet redemptions, and there wasn't enough available in the wholesale market at anywhere near the paper price. So they had 2 choices. Option 1, admit they're running a fractional reserve scam, suspend redemptions, and face the legal and reputational consequences. Option 2, access emergency Fed liquidity, pay any premium necessary to source physical silver, deliver to clients, and hope the problem goes away. They chose option 2. That's why 2 banks pulled $17 billion from the repo window. That's why Shanghai premiums spiked to 12%. That's why South Korean banks shut off retail sales. The system is already breaking. We're just watching it happen in slow motion. Now here's where BlackRock's position becomes absolutely critical to understanding what happens next. When institutional investors realize that paper silver is toxic, that the leverage ratios are unsustainable and redemption risk is real, where do they go? They can't take COMEX delivery in serious size. They can't store 50 million ounces in private vaults. They can't buy from retail dealers without paying 15% premiums and waiting months for delivery. They go to SLV. It's the only institutional-grade vehicle that offers physical silver exposure with daily liquidity. And when that wave of money hits, BlackRock will be legally required to go into the physical market and buy hundreds of millions of additional ounces to back the new shares. In 2020, SLV absorbed 170 million ounces of demand in 6 months, and it nearly broke the physical market. Premiums hit 40%. Mints ran out of blanks. Delivery time stretched to half a year. Now imagine 500 million ounces of institutional demand hitting over 3 months. The math doesn't work. There's not enough silver available at any price. Here's what the supply-demand picture actually looks like when you strip away the paper market fiction. Global silver mine production is approximately 880 million ounces per year. Recycling adds another 180 million ounces. Total new supply, around 1.06 billion ounces annually. Industrial demand, electronics, solar panels, batteries, medical applications, consumes roughly 600 million ounces per year. Jewelry and silverware, another 200 million ounces. Photography and other applications, another 30 million ounces. That's 830 million ounces of industrial and fabrication demand that's not price sensitive. These manufacturers need silver for production. They'll pay whatever they have to pay. That leaves a surplus of about 230 million ounces per year available for investment demand. Now add in the new technologies coming online. Samsung's solid-state battery uses a silver-carbon anode. Not lithium, not nickel. Silver. Each battery requires approximately 1.5 ounces of silver. Samsung's production target for 2027 is 200 million units. That's 300 million ounces of new annual silver demand from one product line alone. The global electric vehicle fleet is projected to grow by 25 million units per year by 2030. Each EV uses roughly 1.5 ounces of silver in various electrical components. That's another 37 million ounces of annual demand. Solar panel installations are accelerating. Each gigawatt of solar capacity requires approximately 2 million ounces of silver. Global solar capacity is adding 400 to 500 gigawatts per year. That's potentially 800 million to 1 billion ounces of silver demand just from solar. Do the math. Industrial demand is about to exceed total global supply. There won't be any surplus left for investment. And that's before we even talk about investor demand, central bank buying, or the unwinding of the fractional reserve banking scheme in precious metals. This is why BlackRock's $40 billion position matters. They're not speculating. They're securing first position in line before the doors close. When the shortage becomes undeniable, when industrial users start bidding against investors for scarce supply, the paper price will become completely detached from reality. Futures markets will go into permanent backwardation. COMEX will implement cash settlement or force majeure clauses. And the only thing that will matter is who has physical possession. Let me show you exactly how this ends because we've seen this movie before with a different metal. In the 1960s, the United States government ran a fractional reserve scheme with silver. They minted coins with 90% silver content while simultaneously issuing far more currency than they had metal to back. In 1964, the jig was up. The U.S. Mint stopped producing silver dimes, quarters, and half dollars. They switched to copper-nickel-clad coins. What happened to the old 90% silver coins? The ones already in circulation, people hoarded them. They disappeared from circulation almost overnight. Gresham's law in action. Bad money drives out good. When you have two forms of currency and one has intrinsic value, people spend the worthless one and save the valuable one. By 1968, the government stopped redeeming silver certificates for physical silver. The window closed. If you held paper promises, you got dollars. If you held physical silver, you had real money. Between 1964 and 1980, the silver content in those old coins went from face value to 50 times face value when silver hit $49. We're watching the exact same pattern repeat right now with investment silver. Paper claims, ETFs, futures, unallocated accounts, are the modern equivalent of silver certificates. Physical silver, coins, bars, allocated holdings, is the modern equivalent of 90% silver coins. When the system breaks, one will be worth face value and the other will be worth its weight in metal. BlackRock knows this. JP Morgan knows this. The South Korean banks know this. That's why they're all making the same move, securing physical metal before the exit door slams shut. Here's the two-path scenario we're facing. Path 1. You hold physical silver or legitimate claims on physical silver, like SLV shares. When the paper market breaks, your position reprices to reflect actual scarcity. Not because of speculation, because of industrial demand that cannot be met with available supply. Your silver could go to $100, $150, $200 per ounce as the paper premium collapses and the real price emerges. Path 2. You hold paper silver. Futures contracts, unallocated accounts, mining stocks, derivatives. When the music stops, you're holding a claim on metal that doesn't exist. The exchange implements cash settlement. The bank suspends redemptions. Your contract settles at the official price, while physical metal trades at 2 times or 3 times that price on the street. You're holding a worthless receipt while others hold the actual asset. This isn't doom porn. This is math. Total above-ground silver inventory is estimated at around 3 billion ounces. Sounds like a lot until you realize that paper claims against that silver are estimated at 50 billion to 75 billion ounces worth of contracts. The leverage is somewhere between 15 to 1 and 25 to 1. In a fractional reserve banking system, that works until it doesn't. Look, I'm not a financial advisor. I don't know your personal situation. I don't know your risk tolerance. I'm not telling you to buy anything or sell anything. I'm showing you the data. I'm showing you the math. And I'm showing you what the smart money is doing while retail investors are still debating whether silver is in a bubble. BlackRock isn't building a $40 billion position because they think silver might go up 20%. They're building this position because they see the same supply-demand deficit that I'm showing you, and they're making sure they control the infrastructure before everyone else realizes what's happening. The window is closing, not in years, in months. When Samsung starts mass production of solid-state batteries in 2027, they'll lock up mine supply with long-term contracts. When solar installations hit critical mass and consume 800 million ounces a year, there won't be surplus silver for investment at any price. When the paper market breaks and institutional money panics into SLV, the premium will explode overnight. The paper price might say $65. The real price, the price you'll actually pay to take delivery of physical metal, could be $100, $120, $150. And at that point, it won't matter what COMEX says the official settlement price is. What matters is who has the metal. Watch the COMEX inventory numbers. I'll keep tracking them. Watch the Shanghai premium. Watch for more banks suspending silver sales. This is moving faster than I expected even 3 months ago. The fractures are already visible if you know where to look. We're past the point of speculation. We're in the documentation phase now. And what the documents show is that BlackRock is front-running the biggest shortage in modern commodity history. The only question left is whether you'll be holding paper promises or physical assets when the system breaks.